I've just finished reading A Random Walk Down Wall Street, and it's completely changed my perspective on investing and finance. The book starts off by explaining two different theories on investing. There's the firm foundation theory and the castle in the air theory. The firm foundation theory says that stocks have an intrinsic value, and this value can be determined by carefully studying the company's past earnings and looking at what potential the company has in the future for making more earnings. If the stock price is below that intrinsic value, then you buy it, and vice versa. The castle in the air theory is based around market mentality. The best illustration of this is the tulip bulb craze. In 17th century Holland, there was a non-fatal virus which affected tulips called mosaic, and what it is it caused the petals to develop really crazy patterns. And these infected bulbs were highly valued by the Dutch, and a craze caught on. The more vivid and bizarre the patterns were, the more highly valued it was. So this caused the prices of tulip bulbs to skyrocket, forming this castle in the air. So it didn't matter that the tulip bulbs were massively overpriced, there'd always be someone else willing to buy them at a greater price. But eventually people started to catch on. They started to think, this castle in the air is going to come crashing down at some point. Some people are going to stop wanting to pay this much for tulip bulbs. So they started being cautious and selling the tulip bulbs off. Then other people noticed that others were doing that. So they started selling theirs, and it snowballed to the point where it caused a mass panic and the prices plummeted until the tulip bulbs were worth no more than a regular onion. So these two theories form the basis for the two main ways people invest in stocks today. Fundamental analysis is based on the firm foundation theory. By analysing the company's fundamentals, such as the earnings and various financial ratios, its true value or intrinsic value can be determined. So if the shares are priced less than that, it's a good idea to buy. But how well does fundamental analysis actually work? 19 of the most respected Wall Street firms were asked to estimate the future earnings of various companies after 5 years. So the results? The estimates weren't accurate at all. So the security analysts said that, 5 years is too far out to predict, we can only really do it to a year. So they said, okay, predict the prices in a year. And the results of that were even less accurate than the 5-year predictions. So the analysts fought back and they said, some industries are harder to predict in the future than others. So they repeated the experiment in various industries, and the results after that showed that no industry is easy to predict. So the lesson from all that is that it's extremely difficult, if not impossible, to consistently predict how companies will perform in the future. Technical analysis is based on the castle in the air theory. Rather than trying to predict what will happen 5 years from now, the only thing you need to look at is the history of the prices. That tells you everything you need to know about how the market is behaving. For example, if the stock fluctuates between two prices, these form support and resistance levels. If the price breaks above the resistance level, that means the crowd mentality has changed and the price will keep rising. Unless it doesn't. Technical analysis also uses patterns. One is known as the head and shoulders pattern. First, the price reaches a peak and then falls. Then it reaches an even higher peak and falls, and then reaches a third peak which is around the same height as the first. This forms the head and shoulders pattern, which is a sign the price is about to fall even further, unless it doesn't. An experiment was conducted where students took some graphing paper, and they took a hypothetical stock worth $50 and they'd flip a coin. If it was heads, they'd add 50 cents to the price, and if it was tails, they would subtract 50 cents. This is known as a random walk, and after repeating this often enough, the charts would form support and resistance areas, heads and shoulder patterns, double peaks and other patterns, even though the price changes were completely random. So these charts were shown to a chartist, and they exclaimed, "Which company is this? This setup's classic, it's going to be up 15 points by next week," only to be disappointed by finding out that this was completely random. It was produced by a coin flip. So the lesson here is you can't consistently predict the movement of share prices. So this brings us to the core principle of the book. If you only remember one thing from this video, let this be it. Buying and holding onto a diversified portfolio of stocks will always outperform the so-called experts in the long run. Share prices follow a random walk and they can't be predicted reliably. So is your money really safe in the stock market? Wouldn't it be better to keep it in savings where it's safe? And what about RBS predicting a cataclysmic 2016? The good news is that even though the stock market may follow a random walk, long term, the stock market is given a return of 7 to 8%. So good luck finding a savings account with that type of return. It's like flipping a coin with a very slight bias towards landing on heads. So even though the prices might rise and fall day to day, and may even see large crashes like in 2008, the longer you keep hold of an investment, the less risk there is. and the market corrects itself to temporary overreactions in price. In fact, those who didn't panic sell in 2008 are continuing to see their portfolios grow. This book covers far more than this, but the key lessons to take away are: don't try and outperform the market. You might be able to short term, you might spot a pattern which works some of the time, but no one can do this consistently. Don't get caught up in any tulip bulb crazes or any next big thing or any rumours, and don't panic sell when there's bad news. And then the third lesson is buy broad-based index funds as early as possible and hold on to them for as long as possible. The compounding returns will see your portfolio grow far bigger than if you'd kept the same amount of money in savings. In fact, keeping money in a savings account will see its value decrease over time due to inflation. So good luck with the investing, and subscribe for more videos like this one.